Personally, I don't have any questions.
Okay. Uh, as you know, we are starting the new chapter and new class with the former semester extension, so-called the macroeconomic part of the economics. So I hope you will enjoy. This is the first class, I think, because last lecture no students attended and it was not done. And this is the so-called the first lecture and first class and first introduction to the course. If you don't have any question, I will give you some information about the course. We have the course outline in the Teams files, and I have the book uploaded. I hope you got it. You have already downloaded. Is there any problem with this? Did you
No,
get
sir.
the book? Did you get the book also? Because the book
Yes.
is not properly uploaded because it was not the right or correct format. But you can read at least the topics online because we don't have any other option. Okay, as you are understanding, macroeconomics is concentrated to the nations level activities. Therefore, we are going to introduce you in this course the aggregate level of activities in economics. So, if you remember from the first part of this class, the microeconomics was concentrated to the individuals and, of course, firms' activities. And here we are going to concentrate to the all firms' activities, so-called the nations level activities in economics. If you do have any question, you will interrupt me and ask me anytime, okay? As you know, microeconomics is the study of how individuals, households, and firms make decisions and how they interact uh, with one another in the markets. Therefore, microeconomics mostly concentrated to the individuals and firms' activities, and macroeconomics, as I said to you, is concentrated to the firms' total collection of the firms, so-called the aggregate level of the activities in the nations. And of course, the whole firm's activities is going to be questioned. Therefore, here we are going to analyze the parameters such as gross domestic production, employment, growth rate. These kind of parameters will be introduced to you and will be analyzed in nations level with the aggregate demand and aggregate supply is in subject. The macroeconomy, as it is given in the book, is the study of economy as a whole. And its goal is to explain the economic changes that affect many households, firms, and markets. As you remember from the microeconomics, one firm's and one individual activity is in the subject. And here, as you see, the households, the total number of the firms, and of course the consumers and producers is in the subject now. And we are going to analyze the whole together in the aggregate level. The macroeconomics answer the questions such as why is the average income high in some countries and why in some countries is low? Because national incomes and average incomes is dependent to the amount of the GDP, which is of course the amount of the goods and services produced in a year. Therefore, as much as the amount of goods and services which is produced in the economy in the nation is going to affect and change the amount of the nations and of course average income, so-called the per capita per income per person will be then enlarged if it is distributed to the whole nations equally. Unfortunately, most nations activities and of course the GDP is not equally distributed. Per capita per income per person is not very fairly distributed. As I mentioned to you in the former lectures, the Saudi Arabia, for example, the GDP is high, but the distribution of the welfare and of course the income is not fairly equally realized. Therefore, there are some people, so-called the creme de la creme, so king and the king families, where they are collecting most of the nation's income and the GDP, and the part of this, some small part of this is going to be distributed to the population, also called the people. Therefore, the average income is in the rich countries, in the developing countries, is more equally distributed, and they are having more welfare and prosperity. And in such countries as in Saudi Arabia or in some other countries where, such as in China and in India and maybe in Turkey and some others, the distribution of the capital is not fairly realized. Therefore, per capita, per income per person is, of course, very low. And the minimum wage is also low, and this also affecting the welfare and development. Sometimes the GDP is, of course, indication or indicator for the so-called growth and, of course, the richness or wealthiness. But if it is not fairly distributed to the nations, to the people, this is, of course, affecting people's welfare and, of course, wealthiness. Why do prices rapidly rise in some periods, whilst they are more stable in others? In some countries, as you are knowing, the inflation is very high. We are also questioning in this lecture the inflation, because inflation is also aggregate parameter, and we are questioning the inflation regarding to the welfare and regarding to the development and impact to the development and welfare. And as you are understanding, inflation is, in the definition, rise of the general price level. And as much as we are increasing this price level, inflation is expected to be parallelly increase and affect the whole other parameters, such as interest rate, which we are going to analyze here, the nominal interest rate, real interest rate, the wages, everything. Therefore, since these parameters are very heavily increased and affect the others, then there is, of course, problem in the economy, because we are trying to analyze the economy regarding to the changes of these parameters. And as much as this price changes, the inflation, nominal interest rate, real interest, all are affected and change quickly in a period of 1 year or 2 years. This is, of course, affecting the whole economy in negative way, because rising the price and, of course, the inflation and other parameters, which is multiplier effect, realize and affect the economy, is not good for the welfare, because inflation causes some resource transfer from consumers to the producers, and it causes some welfare decrease for the consumer, so-called the demand side of the economy, and increase the supply side of the economy. Because, as you are understanding, when you are increasing the price level, the general price level, which is the inflation, is also causing a transfer of some reasonable resources from consumers to the producers. Therefore, capitalist approach is always supporting this kind of applications, and this, of course, negatively affecting the welfare, because on the one side there is the supplier, who are the producer of the goods and services, and on the other side there is consumers, who are the, of course, holder of the factors of production, and also the consumers and buyers of these products and produce goods and services in the system. Therefore, this price increase negatively affecting the consumer side and the demand side of the economy, and positively affect the producer, because there is a reasonable transfer to the producers. Because, as you are understanding, as much as you are increasing the prices, so-called the general price level, this will, of course, contributing the profit, which is the, of course, important part of the capital in the system, where it is distributed and transferred to the producers. And it is not, of course, good, because we are not only concentrating to the supply side of the economics, we have to concentrate to the welfare economics, so-called the consumer side, so-called the social economical aspect of the economics. Therefore, these parameters and these kind of questions is in the subject in this lecture, and we are questioning why some countries are becoming very rich and why and distribute their welfare equally, and why some countries, as I mentioned to you, such as Saudi Arabia, India, in Russia, there are oligarchs where they are very heavily rich and creme de la creme part of the economy, as in Saudi Arabia, as in China. There are some rich people, but most of the people are in middle income, also so lower income level, and they are of course in the poor and poverty level. In Turkey, also in India, as you are understanding, some people getting most of the capital and holding in their hands, and the rest of the nation and rest of the population are unfortunately suffering. And this is of course not acceptable. And we are questioning in this course, in this lecture, why this happens and what to do for enlarging and increasing these parameters as much as possible in the positive direction for enlarging and distributing the prosperity and welfare and standard of living to the population as much as possible into the higher level for making people happy and comfortable in their life. Of course, why do production and employment expand in some years and in the contractionary is of course, not? This is also a question because, as you are understanding, currently we are in the pandemic, and this is of course negatively affecting the economy because the consumption and the demand capacity is reduced. And when you are putting some barriers to the production or reducing the production due to this demand capacity, which is reduced, then is also causing some reduction on the production. Therefore, in some period of time, you are enlarging the economy regarding to this demand and, of course, capacity of the market. And in some period of time, we are exercising currently in the economies in the world, there is a sub to the supply, and there is barriers to the supply. And because of this production, because the countries borders and customs are closed, you are not easily exporting, importing, you are not easily enlarging the production, you are not easily increasing the production capacity, because most of the people are becoming unemployed, or they are having some part-time job, or they are having some reduction on the employment. And this is of course negatively affecting the demand capacity. And when the demand is reduced, this is a recession, because from the supply side of the economics, you are expecting to enlarge without problem, because supply side of the economy is always organized, and the decision-making process is always determined by the producers. But as you are understanding, this is not the only way to enlarge the economy. You have to think about the market capacity, you have to think about the demand, possible demand, the promotion, everything, the price policy, whether it is possible to enlarge and increase it or not. This is negatively affecting and changing the economy in this direction. Therefore, in the macroeconomics, we are questioning this and trying to find a reasonable answer for enlarging and increasing the prosperity and welfare in the nation's level. And judging whether the economy is doing well or poorly, it is the natural to look at the total income that everyone in the economy is earning. Therefore, per capita, per income per person is affected and is expected to become enlarged, whether it is dependent to the income or to the wages. It must be carefully treated, and regarding to these changes in the economy, production is going to be reorganized and rearranged for enlarging an economy in the higher level, because this is not easy to change this position if such as pandemic in the market and reducing the marketing capacity, production capacity, demand capacity, because of the income, because of the salaries, because of the wages, decreasing wages. food and beverages, for example, currently reduced because the hotels are not open. And if it is so, then you are not able to increase and support these catering firms and activities. And it is, of course, expected that this kind of activity is going to be reduced, or the tourism sector is going to be negatively affected or still in the progress. These things, of course, affecting the economy as a whole. Therefore, if the income is in reduction, if the supply side of the economy is trying to develop, but the demand side of the economy is not responding this because of this demand capacity is reduced, because of income is not very well, then economy is also affected, because as I said to you, when the demand is in recession or in the negative way, is going back or is in negative, is going to the left, then we are expecting recession in the economy. We are expecting economical crisis or problems in the agenda, which is not good for the country's performance or the global market. Economy as a whole, income must equal expenditure, because income and expenditure is expected to become equal, which is, of course, the GDP, because GDP is supposed to be supposed to. Mahmoud Salman is trying to come to the class. Is Mahmoud in the class? Because somebody is trying to come to the class, I don't know. Anyway, every transaction has a buyer and seller, as I mentioned to you, and since the buyer and seller is not equally realized, then of course one side becomes overproduction if the buyer is higher and the production is not sufficient, and there is a scarcity. Therefore, vice versa is also similar. If the seller higher in the market and the production is more than buyer, then is, of course, there is a surplus and there is overproduction. And this kind of inequalities may creating problem. Therefore, as a whole, for the economy, income is expected to become equal to the expenditures, which is the desired, let's say, model for the economy for developing the GDP, gross domestic production, because the gross domestic production is the amount of the goods and services which is produced in a year, and this should be equally realized to cover the income, to become equal to the income, or the resources will be then become to the equal to the expenditures, and this will then create no problem. And every dollar of spending by some buyers is a dollar of income for some sellers. Therefore, when you are thinking in this direction, as much as you are giving the wages more, this is then, of course, will be returned to the seller again for increasing and enlarging the economy in this direction. And if it is not realized in this way, and if you reduce the wages, the salaries, you are not expecting to enlarge and increase the economy or the supply side of the economy, because the demand capacity is supposed to be reduced. Or if you are not going to enlarge and increase their economy with the exportation of the goods, you are not able to increase the amount of the goods and services which is produced in the domestic market. This kind of difficulties is affecting and changing the economy very heavily. Therefore, it must be equal, it must be somehow in the equilibrium position. As we know from the former classes, the demand and supply, where it is intersect each other, the suppose economy is becoming to the equilibrium position. Therefore, this kind of equations and equalities will create no problem, will cause no problem to the economy. And the GDP, as I mentioned to you, is a measure of the income and expenditure, or is the amount of the goods and services which is produced in a year. And this is, of course, usually this short-term explanation, because we are producing goods and services in short term, and this is then, of course, as you are understanding, important for the economy, because as much as you are able to produce goods and services in a year, this will then positively affect and change and increase the economy, and of course the gross domestic production will be then positively affected. And this is then, of course, in the other form is explained, income should be equal to the expenditures for realizing sustainable economical application and model in the system. And the equality of income and expenditures can be illustrated with the circular flow diagram, and you will then able to understand why it is important for the economy, because on the one side there is the resources which is collected, and on the other side there is a clockwise and counterclockwise diagram that we are going to introduce to in a few minutes. And the clockwise diagram is supposed to be the collection of the capital, and the counterwork is supposed to be the expenditure. As you are observing here, it is of course given on the upper part, markets for goods and services, which is produced by firms and households, is expected to be sold, and of course bought by the consumers and producers. And in the downside of this diagram, there is a market for factors of production, where you are understanding there is of course land, labor, capital, and these things which is going to be met by the producers and of course the households, and of course paid as wages or as rent, as salaries, as income to the factors of production owners, so-called the households. And on the right side we have the households, and on the left side we have the firms. This diagram is of course expected to create a reasonable circulation for collecting some capital for maintaining this production operation process, so-called the produced goods and services, is going to be realized by using these factors of production. And of course these produced goods and services will be directed to the market where the goods and services distributed. And of course these goods and services which is produced by firms will be then bought by households, and these of course will return to the firms as a income, as a resources, as a revenue. And as you are observing, these goods and services will be bought by the households, which these are the people who are going to sell their labor, rent their land, or put their money to the banking sector as getting some interest for this capital. These are the households and of course owner of the factors of production, and they are also collecting this rent as a income, wages as a salary, and of course interest as a capital profit or interest will be then given to these households to buy some goods and services from this market. And as you are observing this, regarding to this circulation, these households owner of the factors of production will be in the lower part of this market for production or factors of production, will be distributed or will become met with the firms for selling their labor as a wages, capital as interest, as I said to you, and land will be rent, and of course will then given some capital and some income, some resources to the households for circulating this system by buying some goods and services. And these factors of production, which is bought by the firms, will be then distributed again to the of course system as a goods and services, because these factors of production which is going to be used in the system will be put in process as a production operation process and create some reasonable goods and services for distributing and directing to the markets for goods and services. Therefore, the last part of this system is realized now. As you are observing, the land, labor, and capital is going to be distributed and, of course, used by the firms and create some reasonable goods and services to the system. This was the first circulation, which is the factors of production, which is the produce goods and services in the real sector, in the so-called goods market. And there is, of course, a financial market, which is now in the counterpart of this system is realized. In the counterpart of this system, the green line is realized now. The financial system now is in the subject. This goods and services, which is directed to the market for goods and services, will be bought by the households, and this will be directed to the firms as income, as revenue. And this revenue is, of course, a capital for the firms for circulating their economical activities. And as you are seeing, these economical activities, which is collected from the households as a revenue to the firms, will be then distributed again to the factors of production, so-called the households, as rent, wages, and interest, as a profit, which is going to be given to the factors of production owner, so-called the household owner. And this will then, of course, the second part of this financial system, so-called the fiscal financial circulation, is going to be realized. And this rent, this wages, and this profit, which is going to be given to the factors of production, now is becoming as income to the household owner. And this income, which is going to be given to the household owner, will then, of course, again directed to the system as a spending, because household owner is also the owner of the factors of production, and they are using this income for buying some reasonable goods and services for their existence, for their nutrition. And this is then, of course, becoming important for being able to understand the goods market and, of course, the financial markets in the economy, which is illustrated to you with this circular flow diagram. If you have any question, you may ask me, then I will repeat and explain to you, re-analyze to you. If you don't, then I will go to the next slide. Do you have any question? I think there isn't any. You have any question, please? No question?
No, sir, for me.
You are okay. Okay, go to the next slide. Yes, GDP, as I said to you, is the amount of the goods and services which is produced in a year. The period of time is usually a year, and this is then, of course, short term. Maximum in 1 year, we are usually analyzing and evaluating the GDP, so-called the gross domestic production, which is the amount of the goods and services produced in the market. And this is, of course, every year is going to be estimated, and of course, regarding to this development and, of course, enlargement, the economical activities and the resource management will be analyzed and distributed to the public services, to the private sector, to the banking sector, to the financial system. We are going to analyze the amount of the economical activities with this capital, which is going to be collected in a year. And this is then, of course, very important to make some reasonable distinctions, because GDP is not going to analyze with some reasonable calculations where we are going to use, which is determined in a year. The output is devalued at the market price, and you are not going to calculate this output with the former years. And the all output, which is going to be estimated for the GDP, is going to be determined regarding to their final product estimation. If this is not final product, if it is intermediate product, if this is going to be used from other industry and is not directed to the let's say, goods and services market, then you are not going to count this in the GDP. Let's say you have oranges in the market, then this oranges is going to be used or estimated as final product in the system, because this will be in the market and you are going to buy this as a consumer. And this will be, of course, estimated as final product. But if this oranges is not directed, or part of this oranges is not directed to the market and it is directed to the industry for creating some fruit juice, then this is then, of course, semi-finished product. Then you are not going to count this for the GDP estimation. Therefore, this kind of distinction and differences is going to be evaluated for the GDP estimation, and we are only calculating and counting only the final product in the GDP estimation. And it records only the value of final goods, not intermediate goods, and neither the other semi-finished goods, which is not directed to the market. And goods and services, it includes both tangible goods, foods, clothing, cars, and intangible services, haircuts, house cleaning, and doctor visits. These are also included in the GDP. And tangible goods is also expected to be, and intangible goods is also countable for the GDP. The produced goods and services, again, includes to the GDP, so-called the goods and services currently produced, and not transactions in most goods and services from the former year production. Because if there is some goods and services produced from the last year and it is in the market, you cannot count this production in the GDP. You are only going to produce the amount of the goods and services which is produced in a year, in the current year, not in the last year, not in the former year, in the current year. Therefore, you have to count this in the current year. So-called the nowadays production is in the agenda, not the others. And within the country, you are going to count the GDP where it is produced domestically. It measures the value of production within the geographic confines of the country, which means only the domestic market and domestic production operation is going to be calculated for this market. And in a given period of time, as I said to you, is usually count for 1 year, and it is, of course, minimum the quarterly calculated. But this quarter estimation is, of course, will be then calculated and count to the year. We are going to add this and estimate the year's GDP. It measures the value of production that take place within a specific interval of time, usually a year or a quarter, as I said to you. But this is, of course, not preferable. Quarterly estimation is only giving the direction to the government, to the producer, for being able to estimate how they are going to manage and develop their production operation process, whether they are going to reduce it, they are going to enlarge it, or they are going to increase and develop their price policy, their cost and benefits is going to be estimated with this quarterly estimations. And of course, this is the minimum time period which is going to be used in a system. The GDP includes all items produced in the economy and sold legally in the markets. Therefore, illegal production is not accepted. We are only produce goods and services which is legally produced. In illegal drug transfer, for example, or in black market goods and services will not be counted for the GDP. It should be registered. It should be, of course, subject to the tax, and this will then, of course, assumed to be in the GDP. And if it is not, then we cannot count it in the GDP. GDP excludes most items that are produced and consumed at home and that never enter into the marketplace, such as lemonade you are doing at home and you are selling it to the neighbors or to your circumstance, but it is not subjected to the tax. This will not be counted in the GDP. And it excludes the items produced and sold illicitly, and such as illegal drugs, as I said. The illicity is, of course, illegal drug transfers, and illegal drug market is also excluded from this system. we are only concentrating to the legally produced goods and services, which is subject to the tax. And if it is not, then you are not going to calculate for the GDP. When we are going to look up to the GDP for being able to understand the components, let's have look up this. There is, of course, consumption, the C representing the whole consumption, GDP calculation, the components of the GDP, which is going to be calculated, is of course consists of consumption or comprises consumption, the amount of the consumption in a year, the investment, the amount of the investment which is produced in a year or used in the investment, using the saving account, the government purchases or spending is also in the components, and the net export is also in the components. Net exports here means the export, the total amount of the export which is going to be exported to the other countries, and import which is imported from the other countries is going to be subtracted from each other, and we are getting the net export. If the net export is positive, we are having positive let's say numbers, and the current account so-called is expected to be positive, because if you exclude the fiscal part or financial part from this system, the net export is also the indication of the current account, is also representing the current account, where it is expected to be positive for contributing to the economy in the positive direction. If the net export is negative, means the imported goods is higher than the exported goods. Therefore, there is a problem, because you are selling less and you are buying more from the other countries. And this is then, of course, causing some negativities to the economy, because you are giving too much to the other nations and you are getting less from the other nations, because resources which is collected from your economy is also comprised and consists from these parameters, from these collected capitals. And if this net export is negative, means you have some negativities for the economy, which is negatively affecting your capital amount, which is reducing your resources in the system, in the financial system, in the capital market. You are having some negativities. When we are going to illustrate the GDP, so-called the Y represent the GDP, the output is again represented with the equation C plus I plus G plus NX. C is the consumption, the amount of the consumption, because amount of the consumption which is sold in the market is also contributing to the output. The investment, which is the, of course, investment equal to the saving. As much as the saving account is equal to the investment, we are supposing economy is also performing good. Therefore, it should be saving and investment equally realized for creating sustainable, of course, resources and transfer to the economy. Because if you have lower saving account, this means there is a lower transfer to the investment, lower investment realized in the economy. Therefore, you have to enlarge your saving account for being able to increase the investment capacity, because as much as you are invest to your country, this means you are enlarging your economy. For example, you have 5 factory or industry building or holding in your economy, and you want to build one another in a year, then this will then of course require some investment, whether it is coming from foreign direct investment or it is realized in the domestic resources, no problem. This enlargement will contribute positively to the economy, because investing to your country and enlarging your economical activities and economical business capacity is always good, because it is increasing the let's say employment capacity, it is increasing the production capacity, it is increasing the market capacity. Therefore, investment is very important. But if the investment is high, this means there is a high amount of saving capital in the economy, or there is a higher saving or foreign direct investment to your or towards to your economy. And the governmental expenditure, if it is high, also is also a problem for the out, because governmental expenditure is also creating some negativities to the economy. Therefore, governmental expenditure or spending is also contributing to the economy. But if it is higher than its contribution, so-called the income, the collected income from the government is less than the expenditures. This is also negatively affecting and creating problem to the economy. And net export, NX, so-called, is also representing the amount of the net, so-called the export, which is subtracted from export minus import, and we are getting this net export regarding to this trade, so-called the balance of payments, which is realized depending to this or balance of trade, depending to this exportation of goods and importation of goods. And if the imported goods is more than exportable goods or exported goods, this will negatively affect this output, because we are always expecting to increase the exportation and exportable goods, and of course reducing the dependency of the economy to the other nations. Therefore, these parameters are positively or negatively affecting the output and the components of the GDP. Of course, as you are observing, is very important for enlarging and increasing the economy. If it is positive, and if it is negative, it is of course negatively affecting and causing some recession and negative negativities to the economy. The consumption, as I said to you, is the spending of households or spending by households on goods and services, with the exception of purchase of new housing, which is not included here. And the investment is the spending on capital equipment, inventories and structures, including new housing. And governmental purchases or spending, the spending on goods and services by local, state and federal governments. If it is positive and negative, is also, as I said to you, is affecting and changing the total output, also called the Y or the GDP, and does not include transfer payments because they are not made in exchange rate or exchange for currently produced goods and services in the system. Therefore, it is very important to consider this element in the system. And net export is then, of course, export minus imports. If it is positive, as I said to you, it is good, and if it is negative, it is not good, because there is a negative contribution, or so-called the current account will be then in negative or in deficit in the economy is expected. When we are looking here, you are observing the GDP here is given $10 billion. Yes, please.
Yes, sir. Please, could you explain a bit at where it says transfer payment? I don't understand that, please.
This one.
Yeah, this one does not include transfer payment.
Because transfer payments sometimes depending, such as government presence or such things which is not registered. You are understanding these kind of activities is not registered, and is of course not included to the system. Therefore, this is of course excluded. You understand transfer payments? We will exercise, then you will understand what is it. Okay,
no problem. Okay, thank you.
Transfer payments is the payments which is of course coming from somebody and going for somebody, and it is of course sometimes not registered. Therefore, you are not going to put into the system, and you are not going to count it for this estimation for the GDP. And you are going to see here consumption, investment, governmental purchasing, and net export is given here. And as you are collecting this all together, 6,987 plus 1,586 and 1,000 for the governmental purchases, 1,858. And for the net export, usually net export is unfortunately negative, because we are always importing more and exporting less. And regarding to this, of course, we are having negativities, and total amount when we are collecting this is $10 billion, sorry, $82,000 is in the market, is supposed to, or $1 million is in the market, and per person in a dollar is given 35,375, which is very high. Per person per capita is really very high, and consumption is supposed to be 24,506, and investment 5,565, governmental purchase is 6,519, and net export is again minus 1,000 225. This is then, of course, in percentages, 69% consumption or comprises of this GDP from consumption, 16% from the investment, 18% from the governmental purchases, unfortunately, minus 3% from the net export, which is negatively responding results of these export-import differences, which is usually negative and affecting, of course, changing negatively the GDP, also called the output. And when you are getting in a chart this, then the investment is 16%, consumption, as you are seeing, always is the highest percentages, and the governmental purchase is 18%, and the net export is minus 3, representing for the 2001 in a given GDP. I think this is for the United States. And of course, in the other nations, maybe this is differently realized. Real versus nominal GDP. We are now having, of course, real numbers and nominal numbers, or real values and nominal values. Real means you are going to calculate the purchasing power parity. You are going to consider the purchasing power parity. Of course, by time you will understand this, real means, of course, the base year. You are going to calculate everything regarding to the some period of time, which is going to give you more realistic calculation. In the economy, we are making our estimations, our calculations by using the real terms or real values. Nominal values always manipulating the system. Why it is so, I will give you with an example, and you will understand it with an easily explanation. But let's go first this, then I will give you one easy explanation and example, then you will understand it more easily. Nominal GDP values the production of goods and services estimated with current values, current price. For example, if you are going to market in 2021 and you are going to buy one bread, it is, let's say, 15 Turkish lira, let's say full grain bread, 15 Turkish lira, and it was in 2020 only 10 Turkish lira. This means the bread price is 50% increase, isn't it? This is in nominal values. But in real terms, you are going to calculate this, the differences, and then you are going to get the real values, your purchasing power. Then you are going to, of course, getting some values for your wages, some appreciation, some increase for your income in every year with a consolidated income. And this consolidated income not unfortunately given to the, not dependent to the inflation or the rise of the general price level. Therefore, usually nominal price, which is represented and of course given in a current value, is always showing you the amount of the value in current year price and current values. And this is then, of course, should be calculated with real term to see how your purchasing power is developed, whether it is developed or decreased. Usually the purchasing power parity for the consumer is decreasing because the inflation is always negatively affecting and causing some transfer from consumer to the producer, and results of this every year changes affecting and contributing to the real assets, or so-called the suppliers or the producers reserves or capital. And this is of course not acceptable. And the real value is the production. Yes, please.
Yes, one question. So
Yes.
nominal GDP is the current price,
Yeah.
right? So what's going on now, yani? And the real GDP is like the normal GDP, but
no normal GDP, constant price. As I said to you, if you want to calculate, let's say, the development of price or development, let's say you have, I can tell you something easily, then you will understand. Let's say you have $1,000, no, 1,000 Turkish lira. Okay, let's say Turkish lira, because Turkish lira is very easily depreciate, isn't it? The value is depreciating, as in Naira, as in other emerging economies values or currencies. If you have 1,000 Turkish lira in 2000, let's say 19, okay? You are asking Ali Musa, isn't it?
Yes, yes.
Just let me quickly. Ben sizi arayacağım, müsait değilim. Okay, you have 1,000 Turkish lira in 2000 and you are buying, let's say, 1,000 unit bread, okay? 1,000 bread. You got it?
Okay.
It means you have one lira for each bread, okay? You have to spend 1 lira, 1 Turkish lira for each bread. In 2020, let's say you have again 1,000 Turkish lira, but you are now buying, let's say, 500 bread. How
2
do you
lira
see
per
it?
bread.
2 lira per bread, isn't it?
Yes.
If you are looking to these differences, you will understand how your income is in progress or is in decreasing level. Is decreasing, isn't it? Your purchasing power is decreasing because two years ago you are getting 1,000 unit bread and now you are getting 500 unit bread. This means there is 50% probably inflation for the bread price, isn't it? Therefore, you have to calculate this in this direction and determine the real value. The purchasing power of, let's say, Ali Isa, is decreased or was decreasing from 1,000 unit to 500 from 2019 to 2021, isn't it?
Yes.
If you are doing this, you are calculating the real GDP depending to the 2019 values. This is constant price estimation. You are understanding?
Okay,
But if you don't do this, when you are calculating only the current values, you are having 1,000 Turkish lira and you are buying 500 unit bread in 2021, then we don't know what is happening to you, whether your purchasing power is decreasing or increasing. We cannot estimating. We are not able to estimate it, but we are estimating by doing this base year estimation. You understand? Therefore, we can then determine how much your inflation, how much inflation you have in your pocket, whether it is affecting you heavily or not, or whether your purchasing power or your wealthiness or your welfare is decreasing or developing. Therefore, the real GDP is helping you to estimate the amount of the purchasing power of Ali Isa, or nominal GDP, where you are going to estimate only the current values and current purchasing capacity for Ali Isa, then this will then of course giving you the nominal GDP and nominal values. You understand?
Okay, Hojam, I understand, but there's one thing, like it says here at constant prices.
Yes.
How is that constant prices?
Constant price means you are fixing your purchasing power. You are calculating your purchasing power with the 2019 or 2000. In 2000, you may say the bread price is 1 Turkish lira, isn't it?
Yes.
Then you are calculating with the Turkish lira, with this. Therefore, this will then gives you the base year. You have the base year 2019 for calculating this. Otherwise, how you are going to calculate it? You don't know. If you
okay, so you use the basic price.
Yeah, base year, constant price,
the constant basic price, and then you compare.
Base year for 2019, it was 1 lira. If you know the one bread is 1 lira, then this is the base year for calculating the differences between 2019 and 2021, isn't it? Then you are able to make comparison between 2019 and 2021.
Yeah,
you understand?
now
Yes. Or usually the politicians using the nominal values, because if we have in 2000, let's say 19, the GDP, let's say GDP, gross domestic production, let's say 10 billion, let's say, or 100 billion Turkish lira. We have the GDP 100 billion Turkish lira, but in 2000, let's say 20, which is not calculated for the 2001 to 2021. For the 2020, we have 150 billion Turkish lira. Now you have approximately 50 billion increase in the GDP, isn't it? But if you are calculating this in nominal terms, in nominal values, you understand?
Yes.
Not in base year, not in constant year. You may say our economy is developing, but only in let's say monetary value is increasing, not the economy is increasing. Because of the inflation, you have to pay more. That's why the reason, because you know the components of the GDP dependent to the consumption, and consumption of course means you demand capacity, how much you demanded, and what is the value of this demand, isn't it? You understand? Therefore, if demand is 70% and this 70% is of course very heavily important amount for the GDP contribution, then you are understanding the 2020 and 2019 comparison must be done regarding to the base year estimation. If you are going to calculate only the nominal values or nominal current year prices, which is exaggerated your GDP with the numbers, with the monetary values because of the inflation, because in 2019 you produce 100 unit bread and you pay 1 Turkish lira, and multiply this, you have multiply this, you have 1,000, let's say, Turkish lira for contribution to the GDP, isn't it? But if you have this 2020 and you are going to calculate it for your contribution to the GDP, and it is, let's say, again 500, then you are going to multiply it, then you have again 100 units. But if you are producing 1,000 unit bread in 2020 and you are multiplying it with 2, then you have 2,000, isn't it? Turkish lira for 2020 or 2021, which is not able to, which we can calculate 2021 because we are only just newly started this year. Therefore, we are going to calculate the 2020 years estimation for the GDP. Therefore, 2020 contribution of the GDP for the bread is 2,000, which is double price. It is increasing from 1,000 to 2,000. Therefore, it is contributing to the economy almost double size. But this is only realized in nominal values. In normal conditions, you have again 100,000 unit bread in the economy, but you are going to pay 2 Turkish lira for each bread. Therefore, because of this price increase, you are going to double it, 2,000, and this 2,000 will be added to the GDP, to the consumption, which is the components of the GDP. And this GDP, of course, will be then increased not to 2,000, but increased to 2,000, increased not to 1,000, but increased to 2,000. And its contribution to the GDP is 2,000 now, which is higher than the former year. And it may say it's increased. And of course, our GDP is enlarging in nominal terms. The politicians doing this, our economy is enlarged, become more big. But this is not correct because your real GDP, real GDP is in constant, is same, because you have 1,000 unit bread again in 2020, and 2019 is again to 1,000 unit. But in 1,000 unit, you are going to buy for 1 Turkish lira, but in 2020, you are going to pay 2 Turkish lira. Therefore, you have to calculate this 2,000, and this will then, of course, enlarge the GDP and increase in nominal terms. Therefore, this is not real estimation. You have to calculate the GDP also in real terms for being able to determine whether your economy is increasing or your economy is not increasing. I hope you are understanding the differentiation. Most politicians using these nominal terms for telling you that we are developing, our economy is increasing, become bigger, which is not real, which is not realistic approach. You have to use real term or so-called the constant price for estimating the development of the economy depending to the 2019 or 2010. Then you will then determine how your economy is progress, develop in a decade. You are understanding? If you have any question, if you don't understand, ask me. If it is okay, then we go. I hope it is clear with this real and nominal, because we will do some. Yes.
Yes, it's kind of clear, but we're gonna have examples later, yeah. So.
Yeah. Yes, yes, we will have calculations. You mean you will have? Don't worry.
Calculations, examples. So we can
Yes,
understand
yes,
better,
yes.
yeah?
We will
Like,
have. This is we are
Raja,
doing. Yes,
hello.
yes.
Like
Abu
this
Bakar.
thing you are doing here. Yeah, if you can have it face to face, like one day, so that you can explain it deeply.
Yes.
Like what Ali is trying to say, like you have examples, like maybe if you can have it face to face, even at least once, like once for us to understand it more.
I didn't get you really because your voice comes a little bit
Yeah, okay.
not clear.
Like what I'm saying is, can you hear me now?
Yes, yes. If you speak slowly because it comes very faster. I am also doing the same stupid faster speech. Tell me, then I will understand.
Uh, I want us to have it like face to face. Maybe for this one, so that we can understand it.
Example, you mean?
You
Yeah,
won't say face
example,
to
yeah.
face.
Face to face. Ah, you mean class? You mean
Yes,
in the class?
yes.
Example. Yes, yes. I
Yeah.
will sometimes come to the class and we will do it. But you know there are some students online and we have to do it online either. But I will come sometimes. Then we will do some online some class examples when we are going to apply this to the equations. Then I will come to the class also. But I will give you here also some explanations and some easy examples. Then you will understand it. But I will do some online, some live class in the classroom. Then you will understand. Don't worry, okay?
Okay.
Abu
Because
Bakar.
like when we are using the approaches to calculate, like
Yeah,
to determine the GDP and the GNP, will be hard
yeah.
for other people that doesn't understand it. So I prefer like when we do it online, no, face to face. Like if you solve it practically, like face to face, then others may understand it easier. Because
I
using the
know.
approaches like yeah, using the approaches like the income approach and the other approach, so it will be somehow hard for people that newly do the course.
Yes, but we are doing now theoretical part. Don't worry. Let's finish this theoretical
Oh,
part.
okay.
And okay, because it is suggested to do this online. This is not my decision. And
Yeah,
you
yes,
know,
yes.
because of the pandemic, everybody is doing this online. But I will come sometimes to do this, or you may do exercises and you can communicate with me via WhatsApp or via email, then I will control your applications. If it is not correct, then I will give you the correct instruction, then we will do it. Or you can do it here either. Let me first finish this theoretical part because we just start this class and we have to do step by step. Okay, don't worry, Abu
Okay,
Bakar.
thank you.
I
Thank you.
appreciate. Okay, we have here one example for the real and nominal that's going to give you, given to you, that is going to given to you for being able to understand this example. Let's look up this. We have here the price for the hot dog, quantity of hot dog, and price for hamburger, and quantity of hamburger. And we have the years 2001, 2002, and 2003. Therefore, we are going to calculate first the nominal values for each year, 2001, 2002, and 2003, without changing the base year. We are going to use every year prices. As you see, in 2001, it was the price of the hot dog $1. In 2002, it is $2, and in 2003, it is $3. And when you are going to look to the price of the price of the hamburger for 2001, it is $2. The price of the hamburger for the 2002 is $3, and the price of the hamburger for the 2003 is $4. As you see, it is increasing. There is inflation in the economy, isn't it? And when you are looking to the amount of this purchasing, there is 100, 150, and 200. And for the hot dog and for the hamburger, it is 50, 100, and 150. This means for nominal estimations, you have to multiply each of these with the given price, and you are going to get the nominal GDPs for each year. For 2001, you are going to get $1 multiplied 100 hot dog plus $2 per hamburger multiplied with 550 hamburgers. You are going to get $200 for this example. You got it? For the 2002, you have $2 per hot dog multiplied 150 hot dogs plus $3 per hamburger multiplied with 100 hamburger, then you have 600. But as you see, now the price manipulate this calculation. You understanding? Because I will give you the first nominal values, then I will give you the real values, then you will see how the GDP is manipulated with these price changes, because price changes doesn't mean the increase of the production. It is only increase the, of course, value of the monetary amount, but not the production. Maybe production is increased, but not as it is expected with 300. You understanding? Let's see it. And for the 2003, it is multiplied with $3 per hot dog, multiplied with 200 hot dog plus $4 per hamburger multiplied with 150 hamburger, which is going to be 1,200 or $1,200 for 2003, where the GDP calculated for nominal values. And now calculating the real GDP, where the base year is now 2001. You understand? When you are looking here, the base year is now 1, which means you are going to get the base year for 2001. You are going to calculate the real GDP for 2001, 2002, and 2003, but you are going to get the base year 2001 for this example. And $1 per hamburger, $1 per hot dog in 2001 is not changing. You are going to multiply it with 100 hot dogs, and you are going to add this to the 2 per hamburger with the 50 hamburgers, then will gives you $200 for the 2001, which is not changing because we are going to get the base year for 2001. Now you are going to calculate the 2002, but you have now the base year for 2001 numbers, so-called the price is not changed. You are going to accept the price again same for being able to compare the exact development in economy. As you see now, you are going to multiply the $1 per hot dog multiplied with 150, which is only 50 units hot dog is increased in the economy, and you are going to multiply it with the $2 per hamburger multiplied with 100 hamburgers, then this will then give you 350. As you remember, the former year price, it was 600, which is around $250 is manipulated, is increased the GDP because of the inflation, not because of the production. You understand? I hope you understand. You are understanding, yes? And 2003, $1 per hot dog is going to be multiplied for the 2003 years, is 200 hot dog is multiplied and added to the hamburgers, $2 again, because the 2001 year for the hamburger, it was $2 multiplied with the 150 hamburgers, then it's going to give you the 500, which it was in the former year, 1,200, so-called the $1,200, now is 500. As you see, the total increase of the GDP from 2001 to 2002 is only $150, which is in real terms, and from 2002 to 2003 is only again $150. But when we are looking to the nominal terms, you are observing from 2001 to 2002, the nominal increase of the GDP is 400, which is very high. And from 2002 to 2003, it is $600, which is again very high because of the inflation. This numbers is increasing, but in real terms, when you are going to calculate these numbers, you are observing from 2000 to 2002 is only $150, and from 2002 to 2003 is again only $150 increase is observed in GDP. Therefore, this is the better option for the economical development estimation. This is the real term estimation of the economy, which is not, which the inflation, which the impact of the inflation from the economy is excluded. I hope you are understanding this. You have any question? You got it? I think this is, yes, please. Yes.
When you want to look at the GDP, like to figure out what's going on, which one do you look at, the real one or the nominal?
You have to look to the real one.
To the real.
Yes, because this will give you the exact numbers, isn't it? You will see the economical improvements, not the monetary improvements. Monetary improvements means the inflation. You may think about $1 before 1.5 or 2 years ago. It was $2, 2 Turkish lira, isn't it? Something like this, 2.20 or 2.30. But now it is 7. You understand? This is X rate disparities. Okay. Therefore, if you are getting in 2019, let's say 2,300 Turkish lira, and now you are getting 7,000 Turkish lira, this doesn't mean that your income is increased. Your income is consolidated regarding to the X rate disparities, and your consolidated income is only covering your existence because the X rate is still same, because $1 now is around 7 Turkish lira. Therefore, in 2019, you are buying with 2,300 Turkish lira, 1,000 $1,000, and with this 7,000 Turkish lira, again you are getting this. And this doesn't mean that you are becoming rich because your nominal values is increasing, or nominal wages or nominal salary is increasing. You have understood? Therefore, we have to calculate always these real terms for being able to determine whether our existence or our wealthiness is developing, or welfare is increasing, or our GDP is developing or not. Because as you see, real term means you are going to calculate the economical progress in the market. You are going to calculate the development of the economy, not the development of the monetary values, not the development of the nominal, let's say, values. You have understood?
Yes, Hocam, that's one thing. When you look at it, from
yes.
2001, from $200 to 2003 yes. to how much? $500. What do you explain? How do you interpret this?
What was it? Repeat it.
From 2001 to 2003. Okay.
Yes.
It was $200. It became in 2003.
In the example, you mean? In the example?
In the example, yes. From $200 to $500. How do you explain it? Is it good or is it bad?
Yes, with the real terms, it is good. It is developing. It is progressing. At least the economy is increasing, enlarging the economical development, isn't it? The amount of the economy, the production is increasing, is developing, because the inflation is excluded now. But you are observing that the economy is in progress. It is developed
from part, the inflation.
Huh?
That's the bad part, the inflation, because it's excluded. This is improvement. But when it comes to nominal, for example.
Yes, nominal values is exaggerated, because as you see here, you have very high numbers, and the politicians using always the nominal values. They are talking about in 2001, our GDP is $200, but now we have $1,200, or you may say $200 billion, and now we have $1,200 billion, $1.2 billion our economy. It is exaggerated, but in normal conditions, it is only increased $500 billion, let's say, the GDP. You understand? It was 200, but it is increased to 500. Yeah, it is good, but if you multiply it with the real terms, you are getting the real numbers. Sometimes some economies reduce, but the numbers is becoming higher because of the inflation. You understand? This is the problem.
Yes.
Therefore, you may say this is not good.
So basically, when I see a GDP, whatever I see a GDP, if it's high, if it gets higher, this is good. If it gets lower, it's bad, right?
Exactly. Okay, now the GDP deflator we have here. The GDP deflator is the measure of the price level calculated as the ratio of the nominal GDP to the real GDP. You are going to use the GDP for correcting these differences, disparities, because GDP is, of course, as I said to you, if you are not correcting this nominal and real GDPs, you are not able to determine whether it is improving or not. Then therefore we are using this GDP deflator for making some corrections on the GDP deflator, on the GDP, by using this nominal GDP to real GDP ratio, which is multiplied with 100, and this will then give you the real terms, real numbers in the economy. It is given, or it tells us the rise in the nominal GDP that is attributes to a rise in the price rather than a rise in the quantity produced. You have understood. Therefore, as I mentioned to you, we are looking for the economical development, not the monetary development. Monetary development is only maybe realized because of the inflation, because every year inflation is in the market, and this inflation is always enlarging the GDP to 1, to 2, to 2, to 3. Therefore, this doesn't mean that the economy is also in progress. But when you are making this GDP deflation or deflator, when you are using and making some calculations with nominal GDP to real GDP ratio, you will get the real contribution of the economy. As you are observing, the GDP deflator is the nominal GDP will be divided to the real GDP multiplied with 100 and will give you the correction in the economy. The real GDP is, again, as you are observing here, if it is mentioned for 2020, nominal GDP 2020 will be divided to the GDP deflator 2020, then you will get in real GDP, because you are going to replace the positions of the GDP deflator and real GDP. If you put the, from the economics, from the mathematics, if you multiply any number with the denominator, you will replace it or transfer to the other side. And if you transfer this, divided something to the nominator, then you will cancel it and transfer to the other side either. Therefore, this will then gives you the real GDP, which is replaced real GDP deflator place positions. Then will gives you the, of course, real GDP contribution to the economy. Okay, to convert it, so-called. Okay, calculating the GDP deflator here is given GDP deflator. Now we are going to nominal to real GDP. 200 to 200 is 100. 600 to 350, as you are observing, 171, and 1200 will be divided to the 500. We are going to divide it nominal to real GDP. Then we are getting 240 as a GDP deflator, which gives you the real numbers for the economical development or progress. You got it? As you see, is less than or lesser than the expected values from the nominal values or from the real terms which is used. Therefore, this is very good to know for calculating and estimating the real economical contribution to the economy. And real GDP in the United States is given here in a chart from 1970 to 2000 is given. And as you are observing, it is in progress, it is developing. But of course, you have to use the deflator also to see how it is going to be, whether it is in progress or not. But you are observing here, it is sometimes in development or sometimes it is not in development. It is sometimes in progress, but is not as that much as expected as it is from the nominal contribution. GDP and the economic well-being. GDP and the economic well-being is also important, because if you are calculating the real terms and real values, you will determine whether your economy is contributing to the welfare, to the nation's standards of living. Because as much as the economy is enlarged, this means, of course, is going to be affecting and changing the economical well-being and, of course, standards of living in the society. GDP per person tell us the income and the expenditure of the average person in the economy, and of course higher GDP per person indicates the higher standards of living. Therefore, per capita per income per person must be fairly distributed for creating higher living standards, or welfare economics is in subject. If it is not, then of course you may see in the Saudi Arabia higher GDP but very, very low well-being or living standards, or in China or in Turkey or in other economies where the the GDP is sometimes higher than the expected distribution, because the person per capita is not well distributed, is not fairly distributed. GDP is not a perfect measure of the happiness, but it is the quality of life, or it is the quality of life, but it is the measure of the amount for the economy, what is happened to the economy in the numbers. Something that contributes to well-being are not included in GDP. Okay, the value of leisure cannot be, of course, as you are understanding, because the clean environment is also not included, is not calculated. And the value of almost all activities that take place outside of markets, such as the value of times parents spend with their children, and the value of the volunteer works and such things, are not calculated, are not included to the GDP, because this is something else. Happiness is not the GDP, because if you are happy, this doesn't mean you are well-being or your money is too much. Money doesn't make happiness. Only the living standards and the, of course, welfare and your happiness is, of course, countable for your standards of living. But of course, the money is also helping hand for increasing your standards of living or your prosperity in the economy. When you are looking to the life expectation and, of course, the real GDP per person, you are observing the United States, you see 77, and the amount of the money is above $31,872. And as you are observing, when the Germany is 23,742, the life expectation is becoming 78, which is not parallelly gone, but it is at least somehow little bit dependent. When you are looking to Nigeria, Bangladesh, Pakistan, where the GDP per capita per person is lower and weak, then the life expectation is becoming, of course, reduced, because your hospitality, your healthcare, your living standards, your good nutrition, well-being is also dependent sometimes to the money. And this is also important for the comfortable life, and comfortable life expectation is also increased as much as your GDP or per capita per income is increasing, is also affecting your life expectation, because distribution of the capita we are talking about here is high, then is, of course, people's life expectation is also high. This is important because if you are poor, living in a poverty, no heating, no good nutrition, no health care, no schooling, no leisure time, you are working the whole day for $2, for $5, then it's, of course, not good for your life and your health. Therefore, these things also becoming very eligible in the economy. If you have any question, you ask me. If you don't, the transactions as buyer and a seller, the total expenditure in the economy must equal to the total income. As I said, this is then, of course, GDP dependent to the expenditure equality to the expenditure and income, or the GDP is the amount of the money which is produced in a year, the gross domestic production so-called. Therefore, GDP is the market of the all final goods, services produced within the country in a year, and GDP is divided among for the components of expenditure, consumption, investment, governmental purchase, and net export that we mentioned in this class, and nominal GDP used for the current price to value to the economy's production, and real GDP used constant base year price to value to the economy's production of goods and services, and GDP deflator is the calculation of the ratio between nominal and real, or nominal GDP divided to the real GDP for measuring the level of price in the economy. And of course, GDP is a good measure of economy's well-being because people prefer higher to lower incomes. Therefore, it is also contributing to the life expectation. As much as your per capita per income per person is increasing, then your life expectation is also sometimes is contributively and is also positively affected. it is not the perfect measure of well-being, but is also important. But leisure time and clean environment, these things are of course not included to the GDP. As I said to you, this was the today's class. And if you don't have question, I will set you free. And next week we will continue with this measuring the cost of living and of course calculation with this GDP examples and some other applications. I will prepare for you to make some online, of course, interactive lecturing. If you don't have any question, I will finish this class. If you have any question, please let me know.
Yeah, I have a question.
Yes, please.
If you are talking about the monetary value, it is like
Yes.
you have to consider about the nominal, like the normal distance, the normal GDP. You
Yes.
talk about the monetary values because it's where is this inflation occurs, right?
Yes.
Okay, like if the changes, like the changes from the like from a year to year, like from 2001 to 2002, if there's a changes of like 150, and from 2002 to 2003 there's a changes of 150, then meaning it is a real GDP, which it is a real GDP because like it is constant. I mean, yeah.
Your voice is interrupted a little bit. The last part I didn't get it. If you repeat it, or you ask me,
I mean, if there's a constant changes.
Yes.
Between 1 year to another, like if example like the cost of production, like if there's a constant changes of 150, then meaning like we have to consider it under the real GDP.
Yes. This should be, of course, under the it should be under it should be considered like this. In many developed nations, in Germany, the price changes very, very little or never change. Therefore, real or nominal is not very heavily affecting their economy because they have stable inflation. They have more hard and more fixed currencies, and it is not affecting and changing the living standards. You are understanding?
Yes. This is what I mean. And like through the definition of GDP, like is the total monetary value of goods and services.
Yes, in a year.
Is it? Like which a country is able to produce. So it is like if we talk about the GDP. If we talk about the GDP, like the normal and the real GDP, for the constant one, the one constant is actually the real one, right?
Yes. Constant is the real one. Yes. You have to take always the constant value. For example, 2001 should be the constant value for the 2010 also. Then you are calculating everything regarding to the 2001 price with the 2010, no problem. Then you will then determine whether it is in progress, the economy is in progress or not. I will do next lecture one example. I will give you one easy example and one little bit complicated example, then you will understand it better, okay?
Okay, job, thank you.
Okay, thank you.
I have a question, please.
Yes, please.
Yeah, my question has to do with the life expectancy. Are we going to do it in next classes, or please could you tell me what are the determinants of the life expectancy ratio?
What you mean? Example, something like this?
Yeah. What are those things that are within the economy? What are those things that are considered when like determining the life expectancy to be high or low? Because some countries like the US and we saw over there have 70-something years life expectancy, while Nigeria has 60-some or 53 years, like that. Yes. What are those things that are like considered whenever
those are statistics?
Yeah.
Those are facts, statistics.
Yeah, but there are things that are used to determine it, right? What are the factors that?
As I said to you, this is not the only factor. The GDP is not the important factor for affecting the life expectation. But as you are understanding, money talks. You have money, then you have more comfortable life. You have healthcare. You have more better consumption, better life, and this will then of course affecting your life expectation, isn't it? If you are working less than, let's say, 5 hours or 4 hours in a day, and you are getting higher salary and you have leisure time, then it's good for you. But if you have working 12 hours per day and you get $2 for your bread and water, this is then of course affecting your healthcare. You are not going to the doctor, you are not visiting healthcare, or you don't have any leisure time for resting you. These are all affecting. Therefore, of course, distribution of the capital, the per capita, per income should be real term distributed fairly. Then people become healthy and wealthy, isn't it? But if in Saudi Arabia the GDP is high, but the distribution of the capital per GDP per capita per person, then of course this is not realized, isn't it? Then people's life expectation is low, as in China. People working for $2 per day or $1, and of course China is in the second economy in the world or third economy. But this doesn't mean the GDP is high. The GDP should be fairly distributed, and you may talk about the high society or higher living standards. You understand? You got it?
Yes, I got it. I got it. Thank you, sir.
Okay. Next lecture, I will continue with this measuring the cost of living. Then you will understand better, because we have the similar explanations and similar examples in the next lecture with the calculations, and you will understand better, I think. Okay.
Okay, sir. Thank you.
I appreciate for you attending. So see you next Monday. Okay.
Good night.
Thank you.
Thank you.
Okay, sir. Have a nice
Bye-bye.
week.
Thank you. Same to you. Bye bye.
Bye-bye.